You find the perfect setup. The geometry is flawless. You take the trade, and instantly, the market reverses and runs right through your stop loss. When that happens, the immediate reaction is to blame the market. You assume a massive institution hunted your specific order, or that the data is rigged. So you go back to the drawing board, meticulously outlining ascending triangles, bull flags, and head and shoulders formations, hoping the next one holds up. The problem is that you are treating the market like static geometry. A price chart is actually a live, two-sided war between buyers and sellers, where the losing side is forced to pay out the winner. Focusing on the drawing itself often obscures the actual mechanics, because a line on a screen can't account for the volume of orders waiting to be filled at a specific price. A chart is an auction's live tracking system. Amateurs try to read the geometry of the past. Professionals read the mechanics of the auction happening right now. Every single tick of movement up or down is the strict result of order book physics. Buyers and sellers collide, supply is absorbed, and demand is exhausted. Forecasting the mixed move means mapping out where hidden pools of orders are resting, rather than connecting historical price wicks with a diagonal line. When you map those liquidity zones, you discover why some of the most explosive price movements occur precisely when traditional geometric patterns fail and trapped orders are forced into the market. To read the auction, we have to reduce all market activity down to three distinct physical forces. The first force is the limit order. These defending traders sit patiently at specific price thresholds. The second force is the market order, actively consuming the passive supply held by limit defenders. The third force consists of stop orders, invisible landmines resting behind structural boundaries. When attackers consume a limit wall, price hits these landmines. They instantly convert to aggressive market orders, creating a massive chain reaction. Trend lines don't build market structure. Structure is constructed, defended, and broken entirely by the interaction of these three specific order types. Take the standard bull flag. Most amateur material describes this as a small channel or a brief pause after a sharp upward trend. Mechanically, a flag is a live test of supply. The market pauses to see if enough selling pressure exists to reverse the move. If price refuses to drop as sellers step in, limit buyers are absorbing the impact. They soak up every sell order without letting the floor cave in. When price breaks through this compressed boundary, momentum buyers jump in, and trapped short sellers have their stop losses triggered, forcing them to buy. A valid pattern requires this visible evidence of absorption and compression. Without that stored energy, the shape you see is meaningless market noise. A rectangle pattern indicates a temporary balance zone, where buyers and sellers are perfectly content to transact at current limits. But eventually, aggressive buyers consume the entire supply wall, or limit order providers pull their orders. This creates a liquidity vacuum, and price plummets through empty space. Right after that drop, price often returns to the breakout point. This is the retest, and it's the exact moment new traders usually panic, assuming the setup is failing. A true failure is a fake breakout, where price aggressively snaps back inside the balance zone to trap traders who chased the initial move. A genuine retest is mechanical confirmation. The short sellers who were trapped at the bottom of the range are getting stopped out. Their forced exits provide the exact buying pressure needed to catch the falling price. That structural retest is a mathematical stamp of approval, proving the old supply zone is entirely consumed and converted into the new headquarters for buyers. The head and shoulders pattern has survived for decades because it represents a specific mechanical narrative of dying demand. By the time the right shoulder forms, buying control is so exhausted that price cannot even push back up to the head's peak. The neckline acts as the final wall of hope. When the market breaks below it, the synchronized stop losses of everyone who bought are triggered simultaneously. But the most explosive scenario occurs when that breakdown immediately reverses to reclaim the neckline. This is a liquidity trap. The absolute jackpot version of this setup is the busted double top. Price breaks a neckline to invite retail short sellers in, then violently reverses upward to clear the previous highs. This specific failure mechanism reveals massive hidden institutional demand. Larger players purposefully stepped back, allowing the breakdown to generate panic, then absorbed all that retail selling to build their own positions. Failed patterns trap the maximum number of participants on the wrong side of the market. When those traders are forced to liquidate, their panic becomes the exact rocket fuel that drives the highest velocity price expansions on the chart. The market operates as one continuous, unbroken loop. Flags, triangles, and double tops are all just temporary visual costumes worn by this exact same sequence of events. The auction constantly shifts from establishing narrow zones of balance to launching into aggressive price discovery, searching the order book for fresh liquidity. These mechanics do not care about the asset or the time frame. The loop applies identically to a 5-minute cryptocurrency chart and a weekly S&P 500 chart. Recognizing exactly where the auction sits within this operational loop yields a far higher return than memorizing isolated geometric shapes. To stop trading patterns and start trading intent, you need to run every chart through a specific diagnostic framework. Question 1. Where is the order fuel concentrated right now? Look for the most obvious swing highs or lows acting as magnets. Question 2. If price travels to that zone, exactly who is going to be trapped and forced to liquidate their position? Question 3. Is the current environment stuck in a temporary state of balance, or is it engaged in aggressive directional expansion? Run this exact framework over your next 5 live trading sessions. It takes screen time to rewire how your brain processes visual data. True structural edge in any market is achieved only when you stop drawing geometric shapes and begin trading the ruthless, mechanical intent of the auction.